Hey Mason, how are you doing today?
I'm doing great. How are you?
I'm doing good. I was setting everything up and I see we have a nice big crowd, a couple smart people, a couple of people who aren't fully dressed out there with their cameras on. I think it's going to be a very nice presentation until Gassman gets here, then it's going to really not go as well, I think. Hey, how are you doing? I'm doing great. Was just telling the crowd how much I like you. Oh, well, that's good. Thank you. So, anyway, ladies and gentlemen, this would be the time to turn something else on and not watch this terrible presentation. The guy's mouth moves entirely too much. But thank you very much. I'll go draft the documents, and Gaspin will give the mediocre presentation now. All right. Well, I hope I'm a better planner than I am a ventriloquist. And I welcome a lot of friends here. I see a lot of people coming on here at the last minute, all three of you. And I'm here with Mason Hockensmith. Mason is one of our programmers. He works every day, day and night, to make EstateView the best software program that you have ever used on your computer on a Saturday morning, 11 a.m. Eastern Standard Time. So I've got a lot of nice things to share today, but unfortunately, they're mostly about estate tax planning. Before we forget, though, this presentation does not qualify for continuing education credit because it's not good enough. Just remember that. You've been warned. And if you happen to be in Sarasota Tuesday, come and see me either at 8 a.m. or at noon for the Sarasota Distinguished Speakers series. I'm going to be talking on asset protection at 8 a.m. and then spousal limited access trusts at noon. So would love to see you there. You can just register by clicking. And then another free event, Jonathan Blotmacher, Marty Schenkman, Bob Keebler, and I will be answering questions on the new tax law. So the harder the question, the more likely that it will be answered by one of the other panelists besides me. But we thank Susan Lipp of Estate Planning Magazine. Those of you who still subscribe to magazines other than Playboy, uh, we appreciate that. It's a good thing to read things. Also, I'm going to be talking for the UJA on the 56th annual Sidney Kess Estate Tax and Financial Planning Conference, October 22nd, also on creditor protection, and don't forget the Notre Dame Institute. So, if you are not an EstateView subscriber, you have my condolences. You've been missing all the fun, including the hot tub parties and the free liquor on Saturday nights beginning at 11. But you can get a 10-day free trial and just follow those instructions or send me an email. And then we have nice tutorials on our website. And unlike the other software programs, we have 2 weekly tutorial and questions and answers sessions. So if you're using EstateView as a trial user or as a subscriber, you can join Peter Farrell on Wednesdays and Fridays at noon Eastern Standard Time. He'll show you his stuff. You can show him your stuff. And we so much appreciate it. We have added Marty Schenkman on to our EstateView Creative Engine. And enough of this self-promotion. I'm going to show you now some estate plans and talk about estate planning for individuals now that we have a $15 million estate tax exemption. We are very lucky as tax professionals in the estate and gift tax arena that not a lot changed under the BBB. There's a lot of new income tax twists, and you should definitely get your charitable giving underway or well understood in 2025 before these new rules come in 2026. But from an estate tax planning standpoint, what we really have is a lot of people who don't need estate tax planning anymore, or they only need state and not federal estate tax planning, and a lot of people who may want to adapt their planning to provide more income tax planning. For example, if you have an $11 million estate
or a $10 million estate. And when the client is going to die, there's going to be no stepped up basis and also no estate tax. Should you go ahead and give the client a power of appointment over some of the assets that are out of her estate, because there's room to get that new income tax stepped up basis? And if you do it in a leveraged way, then it might have a fantastic result. For example, if you had a client with an $11 million net worth, but she has a trust with a $10 million apartment complex with $8 million of debt on it, under an LLC, under a dynasty trust out of her estate, the property has a very low income tax basis. Maybe it would be worthwhile giving her a power of appointment to direct the assets of that trust on her death. And then on her death, you have $2 million more in the estate for estate tax purposes, but $12 million of appreciation of stepped up basis. So it's important to get with clients. First, find out what their net worth is. We all know that that can be an adventure to even get them to tell us all the information we need. And then secondly, RTN, run the numbers. So we're gonna run some numbers today, and we're gonna have fun doing it, whether you want to or not. By the way, if you have any questions, you can just go ahead and type them into the questions box, and I will pretend not to see them unless I know the answer. But the first question is CPA credit available for this course? And the answer is, if you need a certificate of attendance for your parole officer or your state certification, we'll be glad to give you a certificate of attendance, but we have not pre-registered this for credit. So I'm going to show you where I am. I'm in Clearwater, Florida, but also to show you where I am, I open Estate View. I go to estateview.link, and then I put in, if you're a new subscriber, you would put in your email address and then the password that we gave you for a temporary subscription. But I'll log in, and then when I log in, I get all my buttons here, all my choices, and I will go ahead and set up an estate plan under Instant Plan. So I click on Instant Plan, and now I can either use an old client, and we're going to go over some of the old clients, or I can add a new client. So I'm going to click on Add a New Client, and I'm going to do Calculations Only at the bottom there, and I'm going to give this client a name. And her name is going to be Saturday Night. And I'm going, is she married? Yes. She's married to Thursday morning. And I'm going to fill this in from the blank form. We have a sample data form, but I'll fill it in from the blank form. And I'm going to click Create Client. It's like, what was the day that God created Adam and Eve? It's that day. We're going to create them. Okay, so I clicked Create a Client. Then I waited patiently. And now I've got Saturday and Thursday night. And I'm going to assign Saturday night female and let her be 66 years old, not a tobacco user. Her life expectancy is to age 88. Now, if she's a tobacco user, her life expectancy is age 82. But I'm going to have her as a non-tobacco user. And how much of her estate tax exclusion has she used? Let's say she's used $1 million. So she has $12,990,000 left as of now. If she doesn't make large gifts this year, next year she'll have $15 million minus the $1 million exclusion that she's got. And then under marriage status, we have married no, yes, or we may, Mason, you may want to add a button later that says unfortunately. So that was a joke, Mason. So then we go to the, but you're not married, I am. So anyway, then we go to her spouse, which is Thursday morning. So the relationship of that marriage lasted a long time. Spouse in this situation, we'll go male, and then we'll give the spouse an age, and we'll say that that male is 67, and I don't need to assign a date of birth. I could if I wanted to, but I don't have to. If I do assign a date of birth, then it starts on January 1st and I can move it around. Okay, and let's say that he's used 2,750,000 of his exclusion. Then I click on next. Now, do they have children? Did they want to have children? Maybe, maybe not, but they have 2 children. So I'm not going to even give these, oh, I'll be one of their children. I'd like to inherit. And then the second child can be child 2, creative name, last name, accident. And then let's even give them a grandchild, and the grandchild's name can be John, Exemption, and we will go ahead and have that grandchild. So now, what else is important here? Well, what's really, really, really important is how much are they saving or how much are they spending? Because, you know, you can't assume that they're going to exactly live on their investment income and their Social Security and not be saving more than they spend and adding to that portfolio each year or taking away. And it makes a big difference. So let's say that she's in her prime. She's earning a lot. She's making maybe $1 million a year, and she's saving 600. She's spending 500,000 a year on marriage counseling. And then once she reaches the ripe old age of 74, she's going to slow down her work and only save 200 a year. And then once she reaches age 79, then she's going to do her world tour and spend $300,000 a year. And he's going to do pretty much the same. What happens if she dies before him? Well, she's the bread earner. So he'll be, after she's gone, he'll be spending $250,000 a year every year from the investment portfolio. So obviously, very important to do. Now, they have a home, and it is a $3 million home, and it's growing at 4.75%. That's a pretty generous growth rate because your home gets older every year. So I'm going to say 4%, just to be a little bit more conservative. All right, now she's got, let's say, a 3 million IRA. So I'm going to click here, 3M for 3 million. It's going to grow at 7.5%. And then he's got an IRA of 500,000 growing at 7.5%. 70% stocks, 30% bonds would not be an unusual combination. And then what do they have outside of IRAs and outside of their home? Well, let's say that they have an LLC that has an estimated value of 5 million, growing at 7%. And then they have a brokerage account, 15 million brokerage account, growing at 7.5%. And then they have a bank account, so bank account, and it's worth 4 million. It's growing at 4%. So the total investments, 24 million, 6.81%. And the next thing we want to look at is, are they charitable? And would you like to leave a small amount or a large amount to save estate tax? And the answer, I like to put yes, in case they do. And then the most selfish way to give to charity is to use a charitable lead annuity trust. And we'll be showing the how to get the numbers on that. So now I could review these numbers if I want to, or I can just go to results, click on results. It just did 40,000 calculations. I wish I could charge by the calculation and not by the annual subscription price. And now I've got my handy dandy family tree. That's nice. But what I go to first, if we're talking about estate tax planning, is a married comprehensive view. So what the computer has done is they have followed our protocol for a guess at what you might do for someone in this situation and what would happen financially if you did from a savings amount and estate tax standpoint. Well, they don't think they really need a lot of planning because they're at a $15 million exemption minus $1 million each. So they've got a $3 million house. They've got 27 million of investments. Do they really need to do much? If they die this year, the estate tax is $2.5 million. That's not such a big problem, is it? And then if they do a little bit of planning, we could try a Cupert, but it would fail. And we could do a little bit of gifting this year, and we could do a rolling grat this year, and an installment sale, and a little bit to charity, and that would reduce the estate tax significantly. In fact, the estate tax would be zero, and you would only have to give the charitable lead trust $309,000. So as long as they're willing to die next year, there's not much they need to do. Just let me do these documents. My fees will reduce their taxable estate. So all good. By the way, I got 3 more questions. A certificate of CPA license self-reporting would be helpful. Just need name of program. Okay. The name of the program, date and time, plus name of presenting organization. I'm glad to send that to you. And then another one is, will this qualify for continuing education credit? The answer is yes. Thank you for listening carefully. All right. Now, though, what is their life expectancy? Neither of them are smokers. So the chances are the first spouse will die in 18 years, and the second spouse will die in 26 years. And with the growth rate that we've reviewed, you're going to have $100 million of assets in 18 years and 155 million in assets in 26 years. How does that happen? Well, the rule of thumb is it doubles every 10 years. So right now you've got a $3 million home with a 4% growth rate. In 10 years, it's going to be a bigger home, and investments are going to be much bigger. That home, anyway, that's where you get to these big numbers. The home in 18 years, even a 4% growth rate at 6 million, the investments at 94 million. So they basically almost double twice. Plus you've got the income that you saved. Well, my document provides that on the first death, the amount that can pass estate tax free will go to what we call a credit shelter trust or a bypass trust, which will benefit the surviving spouse, grow, and then never be subject to estate tax on the second death. Well, you definitely do want that. How much will it save? Well, on the first death, 16 million goes there. And by the second death, it's 27 million estate tax free, estate tax reduced to 40 million. Now, we can put their home into 2 qualified personal residence trusts. He puts his half of the home into a Cupert that can be for her and descendants. She puts her half of the home into a Cupert that can be for descendants, and they retain the right to live in the home for what we believe is appropriate would be 80% of their life expectancy. So the Cupert has a 13-year term, and then after that, they start paying rent to stay in the home. Now, the transfer of the $3 million home to the Cupert only uses probably about $1.3 million of gift tax exemption. So the estate tax savings from this little maneuver is huge. Look at that. The estate tax went from 40 million to 35 million. That's $5 million saved. And really all they had to do was sign 2 trusts, transfer the properties into the trusts, and remember at the end of the 13th year to get new trustees and start paying rent. Very few moving parts. And the trust document can have lots of savings clauses. So if you forget to do it right, it may still work fine. That is the qualified personal residence trust. And if anyone likes, we can go to that calculator later and drill down on the design of that. They've got 2 children and a grandchild. They can gift $19,000 a year each to a trust for them. Look at that. At the end of 26 years, just transferring about 60 grand a year for 18 years, and then about half that for 26 years, you're looking at 9 million out of the estate tax. And then if they would gift discounted LLC interests instead of cash, they would have 12 million out. So look at that. Instead of 8 million, they pay us to form an LLC and transfer discounted LLC interests every year. And that puts another 12 million out of their estate tax, saving about $5 million in federal estate tax. It's down to 30 million. Now, they have a little life insurance policy. They could put that into a life insurance trust. But what about an annual gift? I mean, what about a large gift this year? And the computer just automatically chooses a 1/3 of their investment assets. So you see here before their investments are 27.5 million, but after a large gift, it goes to 19.5 million, and the gift trust has 7.9 million, and that's going to grow estate tax free, and they're going to pay the income tax on the dividends, interest, and they're going to keep adding gifting every year. So now that trust went from 12 million after annual gifting with discounts to $56 million. And that trust, or at least most of it, could benefit the spouse. So if Saturday, spouse 1 is the donor, and Thursday, spouse 2 is the beneficiary of that large gift, there's 56 million, or most of 56 million that comes from that, that's exempt from estate tax, reducing that estate tax from 30 million to 15 million. That's a pretty good day. Now they would put 7,920,000 into an LLC, make the LLC 1% voting, 99% non-voting, transfer the 99% non-voting member interest in the LLC a month or 2 later to a spousal limited access trust, saving $15 million. Now, if they don't want to do that, if they don't want to do an installment sale, they could put some of their assets into rolling grats. And for every million they would put into rolling grats, they would be getting payments every year. And our guess would be that for every million they put in the rolling grat, on the second death, 1,587,000 would be out of the estate for estate tax purposes. So if they're not going to put their appreciating assets into an installment sale or a gift, we definitely want to consider a rolling grat. And if time permits, we'll be talking about how to do that. And then finally, the most incredible thing, see, the large gift saves $15 million. But the large gift has a disadvantage. They have to make a large gift. So I'm going to go back to assumptions. Remember, it saves $15 million. And I'm going to turn off the large gift right there. Click back to no. And okay, no more large gift. And instead, we're going to do an installment sale of the same amount. And we're not going to give it, we're going to get back a note at the applicable federal rate of about 4.75%. So I go back to results, and I go back to married couple comprehensive, and I come back down, and the estate tax goes from 30 million to 21 million. So it's a $9 million savings instead of a $15 million savings. But they can get it, they're owed this nice note. So their net worth does not decrease. And they could do a larger installment sale. I can go back to assumptions, and I can move the installment sale from 33% of their investments to 66% of their investments, still with the 30% discount, hit results, hit married comprehensive, and now the estate tax savings, before they had 26.5 of investments and a zero in the gift trust to begin with. The gift trust ended up with 12 million from gifting. Now let's look at the installment sale. Their investments go down to 9 million. They put 17 million into a LLC. And then they sell the 99% non-voting membership interest in the LLC for an $11 million note. The only gift they make here is a seed capital gift of about $1 million. So if they want to unwind this, if they think that pretty soon Congress is going to eliminate the estate tax and they want to be able to unwind it, or they think their children may become ungrateful like everybody else's children, then they can unwind it. But in the meantime, it reduces the estate tax by 12 million. So now the descendants are getting 152 million, and the estate tax is going to be 12 million. They could increase the installment sale, and many clients would, or we can just tell them that instead of paying 11 million of estate tax on the death of the survivor of you, you're going to pay 29 million to a charitable lead annuity trust, which will pay your family charity $18 million over time. And then your children, grandchildren, great-grandchildren can work for the foundation and get paid to do it. And after about 20 years, your children may receive another 12 million. And we could change those assumptions to make the charitable lead annuity trust look a little bit better. But we don't need to. So that's the instant plan using just the married couple mode. Now I'm going to do some more work on this and look at the numbers more in depth. So when we first opened up Estate View, you saw all those buttons for different calculators. I'm going to click Save to Calculators, and I'm going to overwrite whatever's on there, click on Save, and now I can go home and now I can click on any of these calculators, and most of them are now preloaded with the information, but I'm going to go to Married Clients. And you see there that my data has come over to a more complicated and a more flexible and insightful way to look at this. It's the same thing you saw in the middle there, but now I can change the details more. So what this is on the left-hand side, I have my inputs. And for example, I could change the date of death. A lot of people don't think they're going to live as long as the actuarial tables say, or they'd like to know, hey, I'm doing the estate planning now. What would happen if I die sooner in year 8? And then second spouse, I could move that date of death forward or backwards, depending upon how long their grandparents lived, etc. And also, later on, I can stress test this for what if the exemption drops in 2030, just by clicking there. So just to cut down, if after the installment sale, they would still have an estate tax of 8 million. But if I go here and say, what if the exemption goes down to half in 2030 when Governor Newsom gets elected president? And that look at that difference from 8 million to 17 million. And another thing I can do in this mode, which I like to do, is go to timeline, do some time traveling here. Hold on to your hat. Now I'm showing the values on the first death and what would happen if there's a death of both spouses in any of these given years. And the red is the portion that is taken away in estate tax, and I can move the death of the first dying spouse back and forth. Like if you're getting mad at them because they don't pay your bill, you can just kill that first dying spouse off early or wait till late. But you see that large estate tax, even after, so before installment sale, there's the large estate tax. Here's the various trusts that are created. And then after the installment sale, there's that installment sale trust at the bottom. There's a smaller estate tax, but how much installment sale do I need in order to eliminate the estate tax? Well, I can go here and I can just start cranking up the amount that goes in the installment sale. And you see every time I click, the amount going into the LLC goes up. The amount, the value of the gift. So if I have 20,840,000 going into the LLC, the amount of the value of 99% of that is 14,588,000. That's the amount they get back. And the promissory note is 4.76% because you can use the lowest of the long-term applicable federal rate for July, August, or September, and the computer knows that. But there's still a sizable estate tax, even if I crank this up. So crank it up to 22 million. And now you see the installments, the gift trust has 24 million minus a 15 note. The clients only have 2.2 million of investments left, plus they're owed a $14 million note. They're not going to want to go much further than that. But we'd like to eliminate the federal estate tax. So we could reduce the gift by reduce the sale by 5 million to 18,340,000, and then at the same time make a large gift. So let me go back to large gift here. There's large gift, and turn on large gift and take that to 5 million. Now it's a $4,920,000 gift with a 30% discount, only using 3,444,000 of exemption. So with the large gift itself is saving 6 million in estate tax, more than the gift itself. But with the large gift and the installment sale, now the estate tax is down to 9,600,000, and that's what it looks like. So the next thing I can do,
Alan,
yes.
do you think you can zoom in a little bit? Some people with smaller screens are having trouble.
Okay. Yeah, I
So
don't.
if you click in your URL bar, you see on
L
the far
bar.
right, there's a little magnifying glass.
Right here.
Gray
Yep.
area.
Mm-hmm.
Yep. So if you click the plus just a little bit.
Oh, wow. I never knew that. Thank you. Now I'm nonplussed. Okay.
Hopefully that's a little better for people watching.
Yeah, that's neat. All right. So then when I click on testamentary charity, that's the portion that's going to go to the estate tax. But there's something else I can do, and that's called a self-canceling installment note. So when I'm looking at this from an installment sale standpoint, there's no estate tax until 2029. But after 2029, there's a pretty big estate tax. Well, what if this promissory note, which is bearing interest at 4.76%, was going to become self-canceling so that there would be nothing owed if they die during the 14-year term of the note? And in fact, I can move the note up to a 20-year term, and that doesn't change a whole lot. But now I'm going to go back to home, and I'm going to go to self-canceling installment note. So one thing I want to pay attention to when I talk to clients is I want to say, how's your health? And I'm not asking just because I'm interested, even though a lot of times I am. What I really want to know is, should I do a self-canceling installment note? So when I go to the self-canceling installment note calculator, it's showing me 3 self-canceling installment notes. One on spouse 1, who has a life expectancy of 18 years. And if I have a 18-year note and it expires on death, then I would have to charge interest at 7.68%. So a 7.68% note instead of a 4.75% note, and the note vanishes on the first death. Now, if I have this on the second spouse, it would be a 7.83% note. And if I had a joint and survivor note, which is what they may prefer, because then they won't run out of assets, they'll get bigger payments every year, and the interest rate will be lower. So that would be a 22-year, 6.4% note. And if I want to go to 20 years, I can click down there to sale number 3 and move the term of the note from 22 years to 20 years. And now I'm at 6.14%. So I go back to married comprehensive. I go back to my installment sale. And here I will go with 20 years, and I will move the interest rate to 6.17%, I believe I said. And I'll change the note from conventional to self-canceling. Now I'll go back to installment sale and timeline. And now you see a smaller estate tax depending upon the year that they die. So that's worth doing. Now, the Cupert, the first Cupert is failing because the grantor died during the term. Because remember I said I'll kill him off in year 10? So how will the Cupert numbers work? And Cuperts are really underutilized because a lot of planners don't think that they're very good. But we find when you run the numbers that they are. So I'll reduce this Cupert from a 13-year Cupert that fails because he dies in 10 years to an 8-year Cupert. And that, look at that, that gets the estate tax almost to 0 with this combination of techniques. So how did I do that? I have the half of the home at $1.5 million, and then 8 years he lives in it rent-free. Then he starts paying rent at 8% of the value of the home. By the second death, not only is the home out of the estate, but the rent reinvested is out of the estate. So just for fun, I'll say that's an 8-year Cupert, estate tax $16,000. 9-year Cupert, estate tax $135,000. 6-year Cupert, estate tax 0. So really, the shorter the Cupert, the better the result because of the rent that you can pay, plus the rent is reinvested, and the income, dividends, and capital gains from the rent are paid by the grantor, which reduces their estate more. But if I want to drill down on the Cupert, I can go to home and I can click on Cupert. And then I click on Pro Plus, click on results. And there's the Cuperts that were lined up by Instant Plan. A 9-year Cupert of half the home versus a 9-year Cupert of the whole home, depending on whether you did. Typically, you have each spouse put half of the home into a Cupert because then you can take a discount for the fact that it's only half a home. Or if you have a single person, they could put half the home in a Cupert for child one and half the home in a Cupert for child two. And over here on the left, right now you see no discounts because it was programmed for no discounts. But if you were to take a 15% valuation discount, and I'll just click there up to 15%, now you see better estate tax savings because they used less of the exemption. So you see the 305,000 there. When I click the discount down, that goes down just a little bit. It does not make a huge difference, but it does make some degree of difference. Now, but I have to warn the client, there's a potential issue with the Cupert. And this spreadsheet is showing you the years of growth. It'll show you the rent being paid. If I run this for a longer period of time, it'll show. Let me turn on the rent at 8%, paid after the Cupert term. So now you see the cash from the property going up in value, the cash from the rent, and then the estate tax savings on the far right-hand side. But if they sell the house after the Cupert term and after the client dies, or possibly after the Cupert term, and after the client dies, now they're going to have an income tax that is going to reduce the savings. But we still show the estate tax savings minus the capital gains issue. You still have a net gain. But I think it's important to run these numbers for each client and talk to the client on the Cupert. How long will you live? And how long will you keep the property? It's okay if you sell the property and buy another one of equal size. But if you sell the property during the possessory term, let's say the 9-year term, then what happens is if you sell it in year 7, you go over here and you see the annual annuity after sale. You would have to pay the person $51,000 a year from the trust, from the proceeds of the sale of the home. So that's where the Cupert is. Now, a lot of people, they don't want all this complexity, and I can almost understand that. I don't take it too personally, but they might consider just a rolling grat program if nothing else. So I can go back to this couple and I can turn off all of these strategies. They don't want to do any of this stuff, but they're willing to sign a rolling grat document and have their broker provide a rolling grat for them. So here I am with no planning at 38 million, and the only thing they're willing to do is the rolling grat. So what happens with the rolling grat, I'll click on rolling grat there. If $1 million goes into a rolling grat, then in year 22, there'll be $1 million in the grat remainder trust that will escape estate tax. So if I multiply that, if they put all 26 million of their assets into the rolling grat, I'll go down here to the rolling grat. So I change the million to 26 million. So now almost all their investments are in the rolling grat. To the extent that there's growth every 2 years exceeding what's called the 75/20 rate, the excess growth goes into the remainder trust. So for example, if I put 10 million in the rolling grat the rolling grat pays me back in year one half of 10 million plus 4.75% rate of return. So it pays me about, I don't know, 5,500,000. And then at the end of the second year, it pays me another 5,500,000. And what's left in the grat is out of my estate for estate tax purposes. So if the stock market goes up by 20%, that's a lot that ends up in the grat. So the remainder interest in the grat on a 22-year rolling grat arrangement is equal to what you put in the grat. That's not bad. This is estimated. I'm going to go now to the home page and I'm going to go to rolling grats, and I'm going to see if it loaded it up. So I've got a rolling grat with $1 million going into it. And in order to be more accurate as to how the rolling grat will work, I have to decide what the 75/20 rate is going to be every 2 years for the next 21 years. So this is the 75/20 rates from January 2024 to December 31st, 2024. And I'll just use those as my sample varying 75/20 rates. And then I need to know what my growth rate is going to be. So I'm going to click here, and this is the S&P 500 growth rates and loss rates from January 1st, 2024 through, January 1st, 2004 through January 1st, 2024. And look at this. This was quite a year. 2007, I remember it well. S&P 500 went down by 39%. But because they were in rolling grats, the only thing that happened was they got all their payments back. They didn't lose any exemption or anything. And then look at 2003, rate of return 26.89%. So that big variation each year makes rolling grats very attractive. So $1 million in a rolling grat for that 21 year period, I'll click up here to 21 years. If the rolling grat makes annual payments every 2 years at those 75/20 rates and has that rate of return, then just on $1 million at the end of 21 years, there'll be $3.5 million in the rolling grats. So that's not a bad day, but you still, when you run the spreadsheet and you look at those growth rates each year, which you see on this spreadsheet, at the end of the day, your the amount that you get back is still significant. So you still have a significant amount of estate tax. You also have the ability to realize the advantage of the fact that the remainder trust is growing and you're paying the income tax, the client is paying the income tax on the remainder trust. And then I can click here and show you all those grats and what happens under each annual grat. So you got grats 1 through 15 here shown, ages 70 through 91, because you're doing a grat every 2 years. And so this shows you what's in the grat each year. And then as it goes up and down with the market, what's added, and then the total year end for all the grats. So that is the rolling grat. And if you're doing nothing, then you may want to consider at least allowing your broker and your lawyer to work together and do the rolling grat. Although the other techniques I showed you, using the installment sale and a large gift, may work quite a bit better than the rolling grat. So let me go back to clients here and see if we want to do a different client. And this client I'll call Porto and Demi Lisbon. So click on that, and then I open the client, and then they magically appear here after just a minute. They should have magically appeared. Let me go back, click on Porto and Demi Lisbon, click on open client, and not there. Let me try another
You might have
way.
to click somewhere on the page first
Okay.
before it loads the data. Like if you see on the left, it says Porto Lisbon.
The left, Porto Lisbon.
On the left, like where it says client spouse one, input area.
No.
Alan,
So,
click Porto and Demi Lisbon.
okay. Porto and Demi Lisbon. All right.
Click open.
Yep.
Now on the left where you input the information,
Oh, okay. Yep.
you just have to click something over there and it should update.
Okay.
Or maybe not.
Maybe not. All right. So I thought it would take me back to Porto and Mary Lisbon, and didn't happen. All right. So I'll go to File, Open, and then there's find Lisbon. Go to Newton, and there's another couple. Now, this couple has a $5 million residence, and let's move their investments down. So I need to, go back to my Zoom? Well, I won't. So this couple, I will show an installment sale, and I want to move their investments down. So I go down here, find their investments, move them down to a paltry 14 million of investments with growth at 7%, paying taxes and paying brokerage fees. But they also have a company worth, let's say, 2 million too, that's going to be worth 10 million on the sale of the company, if that happens. So they're at 16 million of investments. They're saving 400,000 a year, and they have a nice life expectancy. So you would think they don't need to worry about federal estate tax yet. $6 million house, which costs a lot to maintain. Investments, 16 million, 250. In year 25, 73 million of investments. But what happens in the next few years? Well, they don't have an estate tax to worry about until just before 2030. So the question is, should they do anything about this now or not? And the answer is, what will President Newsom do with the estate tax in 2030? Because if the exemption drops to half in 2030, then there's a sizable estate tax. So vote Republican, not so much for estate tax. Vote Democrat, more estate tax. Certainly a factor. And then if one spouse dies and the other spouse remarries it and loses their portability allowance, there could be another estate tax issue. And it's shown right over here on the right-hand side. This is no remarriage, so you get to use the portability allowance of the spouse who died. And this is remarriage. So it's a little bit of a situation here. So if they will go ahead and do the credit shelter trust, that blocks it down a little bit. But the Cupert on the $5 million house really makes a big difference. So before the bypass trust, the home at 5.7 million in 36 years goes to 25 million, 32 million estate tax. With a double Cupert, taking a discount, paying rent after the Cupert term, you've got 15 million in the Cupert running without the estate tax. One question would be, if these people didn't have a big home, if these people were thinking about getting a big home, but they didn't have a big home, if you, instead of a $15 million estate tax where they had the nice big home, if we increase the investments to 19 million and we turn off the Cupert and we decrease the home to $1 million. Let's see how to do that. Where is that? Cupert, decrease home to $1 million. Then you see a much bigger federal estate tax. So, questions like this is, do you want a big home with a Cupert? Do you want no Cupert? These can make a big difference. So let me go to questions here. I hope that this has been helpful. Some of the people are still on even. And go to questions. All right. So one question is, how do you really use the software? And the answer is, you just get on the software and you start to use it, or you come to one of our free weekly Wednesday or Friday workshops, and we can just take you through it step by step. But what most people do is they start at home, and then they, like I say, they go to Instant Plan, and then in Instant Plan you can add a new client as you showed, or you can bring back a client that you were using. But I'll show you a little bit more of what Instant Plan does beyond the estate tax planning. So I can open the client, and I've been in the calculator only mode, and then I can select what I want to have in my inputs and customize my inputs, and I can change my mode to a comprehensive mode. So for example, I can open this up, have the new client, call it me, call me not married, Marsha left. Well, what the heck, I'll be married. There's Marsha. Okay. And then I can use all fields instead of calculator only. I can create the client, and I'll show you sample data. Create client. Then the client comes up with all this data. Oops, I don't know where that came from. Client comes up with all this data, more information, of course, all the robust output information that you would want. You either send the client a fillable PDF that they fill out, or you can email them access to this portal. They can fill out as much as they care to fill out, and then you can still click results, and now you have a robust family tree. You've got a calendar of birthdays and anniversaries and people's names who you don't know their birthdays. You've got all their contacts. You've got their required minimum distribution results, which you can then change with our calculator, or just show them what this results is. You've got a Monte Carlo simulation telling them possible savings amounts or rates of return. You've got a retirement analysis. You've got showing them a large gift. You've got a Cupert analysis, a skin analysis, a private annuity analysis, so you don't have to go to the separate calculators to get these numbers. And then you have a point of discussion analysis, which tells a lot of planning pointers. and red flags and checklists. For example, this parent you said is wealthy. Is their estate planning done so that you have an inheritance trust? This parent is not so wealthy. Have you done their Medicaid planning? You've got a pet that's a Dalmatian. Have you checked to make sure that you can be insured for a Dalmatian doing damage to people? You've got a 22-foot boat. Is it covered by your umbrella, etc.? Then, or in addition, and what really works best for our law firm is you click on Generate Client Chart, and you could show a client. Choose a married couple that's going to have one joint trust. Click on that, then click on Open. It's showing the client's last name. And I'll pull this from the other screen. So what opens is a robust spreadsheet that I can edit. On the far left-hand side, it's showing me the RMDs with and without charitable contributions from the IRA. It's showing me a summary of all assets and values. It's showing my liability insurance information.
You want to zoom in a little bit.
Okay, there. Where was the zoom?
In the bottom right now.
Bottom right.
Excel.
Okay. Then it's showing me the summary, like I said. It's showing me what's underneath spouse one by entity with values and percentages of ownership. It's showing me what's underneath a joint trust in this situation with values and entities with circles. Showing me the other spouse's assets, the other spouse's RMDs, all of the choices that were made as far as fiduciaries in the PDF that was filled out, the red flag report, which I mentioned, and then a family tree. So when you sit down with a client and you have this information in front of you, or what I'll do on a Zoom call is simply show the chart, and I'll take my notes right here. Notes are taken during the call, and they're watching me take the notes, and they're looking at the entities. There's just a lot of time that can be saved. And then also export to Excel. Click on export there, and now I've got a Excel spreadsheet that just opened right there. Open it up. Where did it go? Try it again. Open up. Should be here somewhere. Maybe it opened below. Close that. Sorry about that. Let me try it one more time. Oops, wrong one. Export to Excel. Export. There it is. Open up. Where did it go? Disappeared. There it is. There it is. User error. This now built a column by column spreadsheet showing what each spouse owns, what category it is, what liabilities are on it, and total values, along with red flags, such as this is a foreign asset, this is a community property asset, all of that properly labeled, and then an asset allocation chart and a financial summary, which will eventually be a financial statement. So, Mason, I've gone over my time. Is there anything that you think that we should show or explain? Okay, let me go to my questions. Let me see. Question there. Don't see the questions.
You have to click the back arrow next to where it says question. Yeah.
Oh, okay. All right. Sorry about that. I didn't see these questions. So Can the program export its data to eMoney? Not yet, but as soon as eMoney calls us, we'll be glad to work on that. Okay. Very good question, Spencer. Is Estate View able to generate simplified variations of plain English client explanations? Yes. You press on the create client letter and up it comes. Alan, and by the way, how do I see how I can get these questions again?
It's the back arrow next to question for it.
Yeah, back arrow. And how do you open that up so I can see the whole question?
I think you have to click on it.
Got it. Okay. All right, that was there. Go back to there. Go back to there. All right. Alan, does owning an asset jointly by separate revocable trust provide creditor protection, or does it depend on state law? It depends on state law. Okay. Bill, how do you enroll in weekly sessions? Well, just send an email or go to estateview.com and you can just click on a few things and you're in the session. Okay, Robin, thank you for telling me what the certificate needs to show. Anyone who requests a certificate by email will definitely get one. Brett, thanks for joining us. Okay, most of the content impact is lost.
He was having a trouble with seeing the text size.
Oh, okay, so we'll have to learn how to use I guess we should just buy all of our subscribers bigger screens. But we'll do our best, Brett, to make this more viewable later. Although I did read you a lot of what I was talking about, but appreciate all those pointers. Can the software do 2 generations in a CRUT? Sorry, only 1 generation at this time. Okay. Carlos, is there a place for final expenses and liabilities on the input? No, we don't. We assume that you're using assets net of liabilities, and we do not have final expenses on the output, but that's something we can certainly consider doing if people think that it's important. Okay, well, let me just answer Spencer's question. When I go to, for example, married clients, it comes on up. By the way, there's an explanatory video down here on the bottom left. You can expand it and watch it while you do the married client work. But I can click on Generate Client Letter, click on Select All Scenarios, click or whatever scenarios I want to show, Generate Client Letter. Now 1,000 squirrels are following the instructions and generating this letter. Each squirrel is typing 1 word, so there's going to be 1,000 words. You see it coming along the bottom blue. It's very exciting, like a 250 meter race. But when it's done, you have a very nice Word document which explains the estate plan, explains the assumptions in the same way that you saw. So what we'll typically do is we'll do a live or recorded session with the client on Zoom. We'll record it if it's live, and then we will go ahead and produce this letter, send it to them, maybe produce a second letter with whatever other scenarios they want to change so they get this. And I can customize the letter. It is a Word document. Usually we don't. We just write a cover letter, typically, that does explain it. In addition, it can generate these illustrations as PowerPoints. And finally, I can click on Share with Client. It's going to give me a code, 220385. I can change that around if I want. I can click on Generate URL, click on Copy to Clipboard. Now this URL is in my browser or on my mouse. I can put this into an email and say, hey, Spencer, I just ran these numbers for you. If you want to use this calculator, just click here and use code 220382 and see for yourself what combination of techniques and what rates of return and what values you would like to see. Finally, I'll just mention in 1 minute or less, if you go to our AI document review, click on New Search, choose Google or OpenAI. I prefer Google. It's faster and I think smarter. Pick on the type of agreement you want to have reviewed. It might be, for example, a healthcare power of attorney. Choose the state where the client is living, and then copy and paste in a Word or PDF document, or you can try a sample document, and it will automatically provide one or more of these items: an executive summary, a table of contents, and then an analysis of each of these aspects of a power of attorney. And once you run the analysis, each section of the analysis, which it's running now, at the bottom, you'll have the opportunity to have it reviewed by another AI to see if there's any hallucinations. You'll have the opportunity to have it summarized. You'll have the opportunity to write a client-friendly letter about it. You'll even have the opportunity to ask the computer to prepare a revised agreement with or an addendum. So down here now, I can have ChatGPT review what Genesis did and tell me how it did. It's interesting to watch them criticize each other. It's like lawyers criticizing each other. So it always learns something, but you'd have the best of both worlds. This is not something you can rely on as a lawyer or a non-lawyer, but it is a heck of an analysis tool because it will usually spot 90% of what I would have spotted, and then it gives me at least 5 to 10 things that I just wouldn't have thought of, wouldn't have even thought to put on a checklist. It is very smart, and it does read the entire document and tell you of inconsistencies, so it's worth it just to put your own document into this. All right, that is our 1 hour talk. It probably seemed like 3 hours. I want to thank everyone who attended with us today. If you'd like to see some different scenarios, let me know. In fact, I'm glad to send you a fillable PDF that you can use to send us, and then we can run an instant plan for you so you can see how it works. Thanks again, Mason. Any final words for me there?
Nope. You're on.
All right. Thanks again. I'm A. Gassman at gassmanpa.com. Love to receive your emails and questions and comments. Have a fantastic rest of your day, and don't trust puppets.
Bye.
Hey guys, it's over. Go home now. I'm going home. Gonna have a scotch and water. But mostly scotch. Thank you.